What is up, guys? Welcome back to another video. As you can see, we now have a face camera, so nice to meet you. My name is Lucas, and I'm here to provide you a simplistic approach to trading the markets. You probably already know a lot of people out there make trading way overcomplicated and more complex than it needs to be. The simpler, the better, and I'm here to make things very simple for you and easy to understand. So, the video of today's topic is a much anticipated one, the unicorn model. It is the strongest algorithmic technique, and in order to understand that, we're going to break this into three parts. First, going to go over what a breaker is. We're going to go over what a fair value gap is, and then we're going to go over a very important aspect, which is time. At the end of this video, we will also be going into some examples to fully understand what a unicorn is, and you will be able to implement this model into your trading by the end. If you find this insightful, if you think a friend might like it, might find it insightful as well, share it, give it a like, comment, and also subscribe. I would really appreciate that. Enough talking. Let's dive right into the good stuff. So we must first understand that the market only reverses in two ways. We have breaker swings and then we have failure swings. Breaker swings take liquidity prior to the reversal, be an old swing high or swing low. They are breaking liquidity, hence the name breaker swings. Failure swings fail to take any liquidity prior to the reversal, hence the name failure swing. Now, these are both just ways of smart money order mitigation. A failure swing is simply a mitigation block, and a breaker swing creates breaker blocks. All right. Now that we understand the only two ways the market can reverse, let's figure out how can we identify a breaker correctly. So let's further understand these breakers. They involve price making a higher high, failing to sustain that high, and then breaking down below a previous low. The focus is on the swing low that formed between the two highs. When price returns to the swing low, it can now be considered as resistance and used for a bearish trade setup. The same is true for the reverse. A bullish breaker happens when the market trades lower, takes out an old low, and then breaks above that high that made the new low. The focus is on the swing high that formed between the two lows. When price returns to this swing high, it can now be considered as support and used for a bullish trade setup. So, to properly mark out the breaker, we want to mark the highest up close candles or series before the leg that took liquidity. We mark the full range, not just the bodies. To properly mark out a bearish breaker, we use the lowest down closed candles or series before the leg up that took liquidity. We mark this full range, not just the bodies. The most important thing when considering a breaker is that it occurs at a higher time frame PD array. PD arrays I use are fair value gaps and swing highs and swing lows. So you want to be looking for them only at these levels, not just at random areas in price. Having a higher time frame narrative is most important. Now that we fully understand a breaker, what is a fair value gap? Fair value gap is a 3-candle pattern where the wick of the first and third candle don't overlap. Fair value gaps show an imbalance in price in the form of one-sided delivery. A bullish fair value gap is what's known as a BISI, buy-side imbalance, sell-side inefficiency. A bearish fair value gap is what's known as a SIBI, sell-side imbalance, buy-side inefficiency. So what resides in this gap? A lack of fair value. There's an imbalance. So price will seek to return to the gap to rebalance the imbalance, essentially just offering fair value. And then once that's done, we can now seek liquidity, higher in the case of a BISI or lower in the case of a SIBI. We now know what a breaker is. We now know what a fair value gap is. Let's combine the two and you get a unicorn entry function, the strongest entry function you will find in the marketplace. So how can we properly identify this? Well, we want to see displacement creating a candle body closure above the breaker high in the case of a bullish breaker. In the case of a bearish breaker, we want to see displacement creating a candle body closure below the breaker low. Most importantly, we want to see that displacement create a fair value gap. So that fair value gap has to be aligning with the breaker. It can't be above it. It can't be below it. It has to be aligning with the breaker, at least a portion of it. Lastly, we need to have unicorns aligned with time. Time is of the utmost importance here. The time and these kill zones provide us with the volatility needed for price to reach its targets. Time is not only just kill zones, but it is also the economic news calendar, which I believe I have a video going over everything you need to know about that. Check that out up here, or where is it? Up here. So check that out. Anyways, back to the kill zones. We need to have a kill zone aligned with our unicorn. You can use the London session. You can use the New York session. If you're going to be trading Forex pairs, I recommend trading the London session 2 a.m. to 5 a.m. Eastern Standard Time. And if you're going to be trading indices, focus on the New York AM session 8 a.m. to 12 p.m. Before diving into some real chart examples, I want to leave you guys off with a checklist to follow in order to identify and determine these high probability unicorn setups, because you just don't want to take any breaker overlapping with the fair value gap at any moment in time. Certain things have to be in line in order to take that. We don't trade patterns. First thing, you want to have a clear drawn liquidity based on the higher time frames. How do you determine this? Well, understand the market does two things: seek liquidity or offer fair value. With your understanding of that, finding a bias is very simple. Second, you want to have a higher time frame PD array in line with that bias, right? So for example, you're bullish, you want to have a 1 hour fair value gap that is also a bullish fair value gap, and take that as long as it aligns with time, right? That's the third point. You want to have time aligned with that unicorn entry function. This means that unicorn must be formed in London session or New York session. And lastly, you want to have the actual unicorn formed. So you want to look for that breaker, and you want to look for that overlapping fair value gap with the breaker. And then when you have all of that combined, you have the unicorn inside of time, inside of a higher time frame PD array, in line with the higher time frame bias drawn liquidity. You have yourself a high probability entry function. So now let's dive into some real chart examples. So here we are on the NASDAQ 4-hour chart. Let's find our draw on liquidity first. So we need to understand that price is trading at all-time highs right here at this moment in time. So there's no reason to look for lower prices. We just want to look for a higher time frame PD array we can use to trade in line with that bullish buy. So what can we see right here? Well, first PD array I see, the only PD array I see, is this 4-hour fair value gap resting low price right there. Now, what else can we observe in this chart? Recall the early concept that was taught on this channel months ago: external range liquidity and internal range liquidity. What's happening right here? We are sweeping external range liquidity. We're now likely going to draw into internal range liquidity. Once we reach that internal range liquidity, we're then likely going to seek external range liquidity again. So ERL to IRL, IRL to ERL. Now that we understand that, we're simply going to wait for price to come into our higher time frame PD array inside of a kill zone and look for our entry model. Here we are on the 5-minute chart. Now we're just waiting for price to enter our higher time frame PD array right here. We are inside of a kill zone, which is this gray shaded box from 8 a.m. to 12 p.m. New York Eastern Standard Time. So let's wait for that breaker to form first, and then that fair value gap to displace right through it. So you can already see the breaker forming right here, potential. We can anticipate that, mark this up as the potential breaker to be. It is the highest up close candle right there that swept lower time frame liquidity right there. Right, perfect. Now we just want to see displacement above this breaker high. And right there, we see the displacement, we see the closure above the breaker, and we see the fair value gap overlining. So now we have a valid unicorn setup right here for us to take. Now, our entry will always come at the high of the breaker. Stop loss will always go at the low of the breaker, and we will simply target to our right off of that. No thinking is really required here. Very mechanical. So now that we're in, let's see how this played out. And I did take this on a personal live account. If you want to see the executions on that, I did post it to Twitter. When was it? July 10th. So if you want to go back and fact check me on that, you can go ahead. So this was that unicorn setup. We had our draw on liquidity. We had our 4-hour PD array, 4-hour fair value gap. We had our entry function occur within a kill zone, and we simply target 2R. Moving on to our next example, we are on the gold futures daily chart right here. First thing we want to find is our bias. What is the bias right here? Well, this is a very simple read. Let me know if you can find it. I'll give you a few seconds right here. All right, we see daily internal range liquidity to external range liquidity. Very simple here. We also just see previous day's low getting swept right here, forming a rejection candle, sweeping that previous day's low, getting some nice displacement right there. We can expect this next daily candle to expand right towards our external range liquidity target. We have a bullish bias, bullish draw on liquidity right here. We want to look in the lower time frames here and find a PD array we can use to get in line. This can be a 1 hour, 4 hour, even a 15-minute gap. Let's do that. Here we are on the 15-minute chart, and we just want to find a PD array we can use to get in line with that bullish higher time frame bias. What do we see right here? Right as we enter the New York kill zone, we see a 15-minute bullish fair value gap being painted right here. We now have a PD array in line with our bias. We can now go down into the lower time frames and look for an entry right there. So I just tried going down into that 1 minute time frame on TradingView, and it just didn't load any of that 1 minute candle data. It's impossible now to look at that since it is a few weeks ago. Here is the Twitter screenshot of the execution right here. We can still look at this just fine. Where's the breaker? Right here. We have that swing low, swing high, breaking this swing low, and then followed by the displacement above that swing high, right? So here is your breaker pattern right there. And then you have that fair value gap right here overlapping with that. You want to mark the highest up close candle right here in this range. We simply enter at the breaker high, right? So this would have been your entry. I was late to this. That's still fine. We enter right there, stop loss below the breaker, and target 2R just like that. And as you can see, we had smooth delivery all the way up to that daily external range liquidity right there. Beautiful unicorn. Here we are on the S&P futures weekly chart. On our next example, we are now first going to look for our draw on liquidity, our bias. How can we determine that? Remember, market does two things. It seeks liquidity or offers fair value. Let's observe the story that was told by price here. We had a weekly fair value gap that could have been the reason for lower prices. Clearly, it failed. Likely to happen next. Fail to offer fair value. There's only one more thing that can happen next, which is seek liquidity. We see that happen, or we see that liquidity right here that we're drawing towards to next likely, and we see an opposing PD array created via this weekly BISI, this bullish fair value gap right here. Now, what is this? This is weekly internal to external right here, IRL to ERL. Beautiful, very clean context we can work with and expect bullish trade setups to present themselves going into this next week. Now let's dive into the lower time frames and see what other PD arrays we can use to actually frame a trade setup within a kill zone. So here we are on the 4-hour chart. We want to confirm a change in state of delivery on this time frame from a weekly level, basically commencing the market maker buy model once we can observe that. So we see that right here. We see a 4-hour fair value gap displacing higher. So let's mark that up. It is a breakaway gap though, so I don't expect price to come down into that level. Let's go down a time frame here and look for a PD array we can use to get in line with these higher prices. Let's move forward in time, and we see a 1-hour fair value gap right here, which is beautiful to now expect higher prices out of, right? We have our bullish bias, and now we have our higher time frame PDA rate in line right here. Let's mark the high of that candle. That's simply buy side external range liquidity. And we have basically 1 hour internal external range right here. Let's go down one more time frame and see if we can find this breaker occur right here, which I already see it. It is simply, let me mark out the diagram actually. If you're still having trouble seeing the breaker, very simple, right? We have a swing low created. Price enters that higher time frame PDA rate. Then we see price displace above this swing high. Price comes back to that swing high. High, right? So think of it this way. Swing low, swing high. That swing high breaks the swing low. Price then breaks above that swing high. We want to mark the up close candle in this range right there with a fair value gap overlapping, right? So this depiction right here can be easily seen right here. Is that lower time frame liquidity sweep there, which on this diagram, which is here, getting a bit messy. Lower time frame liquidity sweep occurs right here. I want to mark the up close candles, this whole range overlapping with this small fair value gap there. I'm going to enter at the high of the breaker and stop loss at the low of the breaker, targeting a 2R from that. Beautiful right there. And our entry occurs right at the kill zone open, right at 8 a.m. Beautiful. Now we just let it ride, target 2R. And there, right here, is your 2R delivered right there. So beautiful, beautiful unicorn example. And yes, I have taken all these setups on the examples being showed today. If you want to fact check me, all the executions have been posted to my Twitter. In case you're worried about me just showing hindsight, there's no hindsight here. Trust in the unicorn. That is the last example for today. It is the strongest algorithmic entry function. Let's go back to full face cam right here. It is the strongest algorithmic entry function. I promise you, if you just follow these few steps, strong liquidity, higher time frame bias in line, inside a kill zone, target 2R, follow those 4 things, you're going to make a lot of money and your win rate's about to skyrocket. This is a gem of a model. I hope you guys enjoyed this video a ton. If, again, you enjoyed it, please like, please share, comment, and subscribe. I would really appreciate that. Last thing I should mention, I have a free Discord where all we talk about is unicorns pretty much every single day. Majority of the people in there are trading them. So if you're looking for a community that trades just like this and you want to learn more about this, also hold weekly forecasts every Sunday and pretty much answer any of you guys' question. I'm always in there, very active. It's a very nice, positive community. Everybody helps each other out. Join the Discord. The link is below, and we'll see you in there. Thanks for tuning in, guys. Love you. Until the next one, peace out.